So guys, what do you do when the stock market is declining like this? Some days up 100 points, some days down 200 points. When do you buy? Do you know if it's the lowest point? Is it going to crash or is it just a correction? I mean, look at Facebook, for instance. Stock initially dropped at the beginning of the year because of the Analytica data scandal, the Cambridge data scandal. Dropped all the way down to 150. And since then, it recovered. It went all the way up to 200, I think even past 200. And then recently, because it didn't make as much money as expected. I mean, last year made 15 billion in profit. So because last quarter it didn't make as much money as expected, stock drops 20% or more than 20% back down to like 170s. I mean, I've never seen a stock drop 20% just because it didn't make as much as expected. I mean, last year made 15 billion in profit, and all of a sudden investors are that worried, that concerned about Facebook's future that the stock drops 20%. It's almost like there's something else moving the stock that we don't know what it is, and they just look to blame the drop on something else. It's almost like the movement happens first and then they just come up with news or try to match news to explain the movement, but most of the time it's really unrelated or doesn't justify a 20% drop, especially for a company that just made 15 billion in profit. How can you be worried? I mean, the business model of Facebook is so simple. It's really hard to find something that could break it. So if you've watched my last video, I bought some Facebook shares at 168. That was 2 days ago. Yesterday it dropped harder. I think it reached almost 161. It closed at 161 today. It's around the same thing. I think went back up to 164. So what should you do? Should you buy some more at the same price? What if it crashes? Do you wait until it crashes before you buy more, or do you panic and sell? So here's the thing: you obviously don't know what's going to happen. Nobody knows what's going to happen. You don't know if the market's going to crash and the stock is going to drop even more, and you don't know what the lowest point is either. So in my opinion, what I would do is, as long as I'm looking at stocks that I'm confident are not going to disappear, are not going to go bankrupt, they have a competitive advantage, they have a strong brand, the business model makes sense. So as long as I'm looking at stocks or companies with that description, whenever it goes down, whenever the price goes down, I see it as a buying opportunity. Because the only way to make money on the stock market is by buying low, selling high, the capital gain. So you need to buy low in order to sell high. So although you're not supposed to look at past performance to predict what's going to happen in the future, so just because the stock was trading at 200 doesn't mean that it's going to go back to 200, but in my opinion, there's a pretty good chance that it's going to go back to 200 and surpass it, because the general direction of a stock is to go up. People are working hard to push the stock price to go up. When it goes down, that's not the general direction. That's not the goal. That's just an obstacle, a temporary obstacle. And the fact that it used to be at 200 gives me more confidence to think that eventually, if it's been there before, it's going to go back to it again. So whenever a stock goes down, depending on how much it goes down, it needs to be at least 10%. It needs to go down by at least 10%. It really depends on the chart too. I only get interested if it's a new 52-week low or close to it. So now I bought Facebook at 168. Should I buy some more at 164 or at 162? So what I would do is I would wait at least until the stock drops another 10%. So if I bought it at 168, 10% less than that is about 152. So if the stock drops to 152, then I would buy some more, because that would make me average my purchase price. Instead of owning shares of Facebook at 168 or 152, I'll be owning at around 158, let's say, because that's the average. So if ever the stock goes back up to 170 or 180, I'm already at a decent capital gain. Also, I don't want to buy, let's say I bought at 168, I don't want to buy at 164, because what if it drops again to 150? So I just missed out on buying at 150. What if it crashes and it goes to 100 or even lower? So I want to separate. I want there to be enough gap between my purchases, so that the average purchase price is lower. And if I didn't buy at 160, so I bought at 168, it reaches 162, and then it decides to go, and then it goes back up. I'm not going to feel bad that I didn't buy at 162, because the difference between 168 and 162 is not that much. So I didn't really miss out on much. But I find that 10% gap is missing out on an opportunity. So definitely at a 10% difference, I'd buy more of the same stock if I can. And then I just wait, because obviously I don't know what the lowest point is. I can only estimate the lowest point. But as long as I buy relatively low, so low compared to other prices, then I'm confident that I'll be able to sell it a little bit higher and make a capital gain. For another example is Ford. Ford today reached 9.2 almost. It's been dropping really for no reason. Yesterday, news came out that it's recalling a bunch of trucks because of a seatbelt issue, and the stock did not react yesterday to that news. Although it came out yesterday and it didn't react to the news yesterday. And now today the stock is trading at 9.2. It dropped pretty hard today, because I think yesterday closed at 9.5. Today it's at 9.2. And now they're blaming the drop because of the seatbelt. But the news of the seatbelt came out yesterday. So sometimes stocks just move just because of its general market, not necessarily something specific to the stock or the company. So in the case of Ford, don't know exactly what's making it drop. Maybe investors are not too comfortable with the strategy of the new CEO, but to me it makes sense. He's trying to limit the number of models, which would decrease expenses and allow them to focus on less things. And the more focused you are, the better, the profitable you will be. So it's just a matter of the CEO showing the public or proving to the public that his idea works. If that's really the issue, if that's really what's making the stock price fall like that. But regardless, because Ford is a company that I know is not going to disappear, it's making, I think, over 150 billion in revenue, also billions in profit every year. So it's a stock I would definitely buy at this price, 9.2. I've already bought some, so I'm not going to buy more. If it drops below 9, then I would probably buy some more. But I already have 5,000 in Ford, and it pays very good dividends. It pays almost 6% right now dividends. So it's a stock I would just buy. I bought at 10.95. I bought at 10, and I guess if it drops below 9, I could buy some more. I also bought options of Ford, and that's what's annoying me, because as you can see, options fluctuate a lot, and I'm down 50% on one of my options. And the thing with options, I'm limited with time, so the Ford stock has to reach 10.5 at least before January 2020. So if there's no market crash, it's very doable. But if there's a market crash in the next 1 or 2 years, then I could lose everything I put in the options, which is about, I think I put around 1,400 in options. So that's the only thing that I regret doing. But in terms of buying the stock, I have no regret, because while I'm waiting, I'm collecting dividends 6% per year. So patience is it's very important to be patient, to give yourself an opportunity to buy at a lower price. Don't just buy just because you want to participate in the stock or in the trend. You have to accept sometimes that you missed out on the opportunity and look for something else. There's a lot of opportunities. Like just right now, GM looks really good, trading at around $33, 52-week low, pays 5% dividends, and it's a stock on Warren Buffett's list. You've got Tesla, a little bit shaky, but great brand, great product. Even if you've got competitors of Tesla or people trying to come up with electric cars, also Tesla's cars are amazing. So the way I judge a company is basically if I use the product or the service. Let's say you go into a Starbucks and you see that it's always full. That gives you confidence that the company is making money. The company is doing something right. But if you go to a Sears, for example, and you see that it's really empty and prices are high and things are always disorganized, never in its place, then you wouldn't be confident in buying the stock. So it's really not that hard to judge a company. Just look around you. If you're using the brand, if you're a consumer of the brand, you can tell if it's a good company or not. So right now you've got GM, Ford, Tesla, Facebook, of course, Alibaba. Alibaba's got great growth. It's really underpriced right now. You've got Bank of Nova Scotia on the Canadian Stock Exchange, pays 4% dividends, and it's at a 52-week low or close to it. So just so many opportunities. So yeah, as long as you focus on companies that don't disappear, don't panic when the prices drop. Just keep buying more of that stock, but make sure there's enough gap between every purchase so that you're averaging down enough. I think a 10% gap makes sense to me. you can make your own decision, your own calculation. So if you repurchase at 10% lower, then you've just averaged down by 5%, which is not bad. All right, so I hope this video was beneficial to you. If you have any questions, leave in the comments below. If you're gonna open an account with Questrade, use my referral code in the description below the video, so you can get between $25 and $250, depending on your initial deposit. Thanks for watching.